Hello and welcome to this Great Investors edition of Wealth Track. I'm Consuelo Mack. This week our great investor is Robert Rodriguez, a maverick money manager who has accomplished a feat no one else has. For the last 25 years, he has run not one, but two top-performing mutual funds in not one, but two asset classes, a stock fund and a bond fund. As widely followed personal finance columnist Jason Zweig put it, that is the investing equivalent of running two marathons at the same time, which is why Zweig calls him the best fund manager of our time. Rodriguez is the CEO of Los Angeles-based First Pacific Advisors and co-portfolio manager of FPA Capital, a mid-cap value fund, and FPA New Income, his bond fund, which just celebrated its 25th year in positive territory. In a wide-ranging interview, I asked Rodriguez about his exceptional track record, which he attributes to discipline and the ability to balance fear and greed.
I think we have a healthy dose here of skepticism about our capabilities. When you've had some serious failures, it forces you to look inwardly. And I don't know of too many organizations where an investment professional puts his worst investment failure on his website. And it just tells you that no matter how skilled you are in this field, there are new ways to snatch defeat from the jaws of victory. So you have to balance these things. And we test ourselves daily on this, whether we are correct in our assumptions, but we don't want to let the day-to-day machinations in the marketplace disturb our long-term thinking. So
let's talk about some of your unconventional current calls. You're describing the current economic state that we're in as a repression, which it's not as bad as the Great Depression, but it's also worse than a recession. Where's this repression taking us? What's it going to feel like?
Here in the firm, we're using a new term for the economy. We're calling it the caterpillar economy, where it goes up, then goes down, goes up and goes down, but it doesn't move forward very fast, after this waterfall collapse that we had. And this is different from any other kind of economic environment that we've been in since the Depression. You don't destroy the consumer's balance sheet like what's gone on. You don't have the leverage in the system that we have and expect to come out of it the way we've come out of other periods. The president, I argued that I think he's on the wrong road. And when I compare him to, let's say, FDR when he came into power, the debt to GDP was barely 17% when FDR came here, whereas we're now at 65%, going to 75%, going to 90% this year. And
IMF says 100 and some odd percent.
Right. And so we're in a, and by the way, those numbers when FDR came into power did not include, because we didn't have any, entitlements. So if you add on the entitlements in here, it's even far larger. So as I've argued, is that we do not have the balance sheet flexibility today as we did in FDR's time. So if they want to go down, they being the Congress and the executive branch, et cetera, and they want to build up these larger programs, they're going to come at a price. And in our opinion, that price will be in the debt market and in the treasury market longer term, with higher interest rates.
So how do you invest in an environment that's going to be substandard growth that you don't know, you don't know what the rules of the game are because you don't know what the government's going to do next? What do you do?
It's going to be very hard. As a result, on the fixed income side, we're still maintaining our highest levels of quality. We haven't gone into the lower rungs or the high yield area, even though there's been big runs there, because we think this is a head fake of what's going on in the economy and this rebound, the green shoots that people talk about. So we're going to stay high quality and let other people destroy themselves. On the equity side, we think you have to be very focused in terms of the industries you go after. So we have a natural decline rate in, let's say, energy, supplies of energy. So we think longer term, 3, 5, 10 years, energy prices are going to be considerably elevated from where they are today. So we have a heavy exposure there. We're-
Heavy, like 55% of the FPA capital portfolio, is that right? Is in
Well,
energy?
it's about 41% of the total portfolio, about 55% of the equity.
Equity, yeah.
Okay, and so we're looking for other areas to deploy capital that will both benefit from the international side, but also from the commodities side. So we see you have to be rifle shooting over the course of the next 5 years or 10 years.
So let's also talk about the fact that you are a long-term investor, but you told me that you look out, some people say long-term, like, a couple of years. You're really talking about 5 to 9 years. And you've made a decision about 6 years ago to take a sabbatical next year from your firm in 2010. And one of the reasons that you decided to take a sabbatical as well is because you looked out beyond the current crisis and you see something even bigger and scarier coming?
I see another crisis coming.
Yeah. What is that, and like when?
It's the explosion in the Treasury debt and the finances of this country. We still have time, but to, shall we say, become fiscally responsible. Am I optimistic about us doing that? No. You're residing in the state of California that I left here 4 years ago because, in my opinion, the system was fundamentally broken and the state was going to experience a devastating recession on the downside.
Which it is right now.
Which it is right now. I believe the system in Washington is fundamentally broken. And as a result, the explosion in debt that I foresee in the next 3 years, and if other programs are added on, it will accelerate it, that I think we have a real problem brewing in our finances here. I'm estimating somewhere in the neighborhood of 5 to 7 years.
From here?
From here.
Do you envision any time when in FPA income basically going out the risk curve a little bit? I mean, is there anything, you've got about 90% in AAA rated securities in the portfolio?
And we have 22% in cash, and we're barely over a 1-year duration. We've had as much as 25% of the fund in high yield. We would love to go out on the risk curve. In the last 6 months, 8 months, it's been highly profitable, just like the stock market is rallying.
Right.
Like that. Is this sustainable? We don't think so. We think there's other dominoes to fall that can disrupt this. So we don't like the odds. Plus, in new income, people come into the bond fund in new income because they can trust it. It's when they couldn't trust virtually anything else in this country other than treasuries. Our bond fund grew in the neighborhood of 60 to 80%. People came in because they could trust it. Well, here we are saying, how do we be good stewards going forward? Do we bet with other people's money, or do we invest as if it's our money?